All right, here is the self-test for Chapter 4. I'll just give the same disclaimer I always give you guys, which is stay to the end because I will make mistakes as we go. On the last one, I think I missed 2. And so then after we check it, I'll correct them and explain why they were wrong. Part of the reason I make mistakes is because, well, I'm human, and sometimes these questions are written to make it challenging. And the other reason is I'm trying to hurry through it. Hopefully when you take the exams and the quizzes, you don't rush through it, and you do check each thing every time. Nobody expects you to get 100% on every exam or quiz, but I hope for you to be able to get an A, or at least a B, even though I know sometimes they're very challenging. So with that being said, let me start. The revenue recognition principle dictates that revenue is recognized in the period in which cash is received. We know that the revenue recognition principle tells us that we should recognize revenue when we've earned it, regardless of when cash is received. So this is false. The expense recognition principle, number 2, requires that expenses be recognized in the same period that they are paid. Again, that's false, by the same principle as number 1. We should recognize expenses when we incur them, regardless of when we pay them. Number 3, what is the periodicity assumption? I promise you that's a real word. So let's look at our options. Companies should recognize revenue in the accounting period in which the performance obligation is satisfied. Companies should match expenses with revenues. The economic life of a business can be divided into artificial time periods, or the fiscal year should correspond with the calendar year. So the answer to this one is C. Periodicity refers to the assumption that we can divide the business's life up into artificial time periods. Then we use those periods for deciding when we should recognize revenue and expense. All right, number 4. Which principle dictates that efforts or expenses be matched with results, revenues? Expense recognition, historical cost, periodicity, or revenue recognition principle? And the answer to this one is the expense recognition principle. In essence, the expense recognition principle tells us to have our expenses match or follow our results. Number 5, the generally accepted accounting principle which dictates that revenue be recognized in the accounting period in which the performance obligation is satisfied is the, and that one is the revenue recognition principle. Again, I think that wording is confusing. Someone tried to make it sound really fancy. Really all it means is when we earn revenue, we recognize it. And we earn revenue by delivering product or service to the customer. So when we do the work, that's when we've earned the revenue. Even if the customer is not going to pay us till next month, or even if they've paid us in the past, we don't recognize it as revenue until we've earned it by delivering the product or service. Or by their word is the performance obligation is satisfied. That's their way of saying when you've either delivered the product or the service. All right, 6, the cash basis of accounting is in accordance with generally accepted accounting principles, and that is false. We use accrual-based accounting in accordance with generally accepted accounting principles. 7, if revenues are recognized only when a customer pays, what method of accounting is being used? Remember, we said in accrual-based accounting that when we receive the money has nothing to do with when we record the revenue or recognize the revenue, but rather when we've earned the revenue by performing the service or selling the good. So it's definitely not accrual-based. And then the other two here, recognition and matching basis, those aren't even real methods of accounting. So cash basis is the answer. If revenues are recognized only when the customer pays, we're using the cash basis. 8, which of these statements about the accrual basis, not accrual a basis, that'd just be weird. The accrual basis of accounting is false. Companies record events that change the company's financial statements in the periods in which the event occurs. Okay. Companies recognize revenue in the period in which the performance obligation is satisfied. Yeah, we know that's true. The basis is in accord with generally accepted accounting principles. Okay, that's true. Companies record revenue only when they receive cash and record expense only when they pay out cash. We know that's false. That's not accrual-based accounting. That is cash-based accounting. In 2013, Costello Company performs work for a customer and bills the customer $10,000. It also pays expenses of $3,000. The customer pays Costello in 2014. If Costello uses the accrual basis of accounting, then Costello will report the revenue from the work they performed in 2013 and the expenses that are related to that revenue. So they will report a revenue of $10,000 and an expense of $3,000. Let's see, so they'll report a revenue of $10,000 in 2013, that's true. Revenue of $10,000 in 2014, that's not true. Expenses of $3,000 in 2014, that's not true. Net income of $7,000 in 2014, not true. It will be a net income of $7,000 in 2013. Anyway, A is the only correct answer. Which statement is correct? As long as a company consistently uses the cash basis of accounting, generally accepted accounting principles allow its use. We know that's not true. The use of the cash basis of accounting violates both revenue recognition and expense recognition principles. That's true. The cash basis of accounting is objective because no one can be certain of the amount of revenue until the cash is received. I see where they're going with this, but I'm going to say it's not true because it's unobjective in other ways. As long as management is ethical, there are no problems with using the cash basis of accounting, except that it's not a generally accepted accounting principle. So we're going to say the use of cash basis accounting violates revenue and expense recognition principles. Accrued expenses are expenses that have already been paid. And of course this is false because an accrued expense is an expense that we've incurred but have not yet paid. So this is the opposite. So an accrued expense is an expense that has already been paid. Nope, an accrued expense is an expense that has been incurred but not yet paid. Which of the following is not a type of adjusting entry? We have prepaid expenses. That's a type of deferral. So yes, that's one of the adjusting entries. Earned revenues, that's not an adjusting entry. That's just what we record when we earn revenues. Accrued revenues, that is an adjusting entry. And accrued expenses. So B is the one that is not a type of adjusting entry. 13. Adjusting entries are made to ensure that expenses are recognized in the period in which they are incurred. Okay. Revenues are recorded in the period in which the performance obligation is satisfied. Yes, as well. Balance sheet and income statement accounts have correct balances at the end of an accounting period. True. So this is an all of the above. Answers are correct. 14. Each of the following is a major type or category of adjusting entry except. So this is just like question 12. Prepaid expenses? Yes. Accrued revenues? Yes. Accrued expenses? Yes. Earned expenses? No. We don't earn expenses. The other one is unearned revenues, by the way. That's the fourth one. All right, number 15. Which one of the following is not a justification for adjusting entries? So another similar question to number 13. Adjusting entries are necessary to ensure that the revenue recognition principle is followed. Yes, true. Adjusting entries are necessary to ensure that the expense recognition principle is followed. Also true. Adjusting entries are necessary to enable financial statements to be in conformity with GAAP, that's generally accepted accounting principles. Also true. Adjusting entries are necessary to bring the general ledger accounts in line with the budget. I don't even know what that means. A budget is something we use for planning, and then we check our general ledger accounts and see if they've met the budget. Really, budgets usually look a lot more like an income statement, but we can have a budgeted balance sheet as well, and other budgeted statements. But we don't bring them in line. Instead, we compare them, and then we make adjustments for the next period. So D is not a justification for adjusting entries. 16, book value is equal to cost minus accumulated depreciation. That is true. That's what book value is. And of course, that relates to all long-term assets or non-current assets. Sometimes they're called things like property, plant, and equipment. And also it could be things like patents and other intangible assets as well. All right. except we don't call it depreciation with intangibles, we call it amortization, but it's the same principle. We'll learn more about it later, don't worry. All right, 17, cash received before services are performed, which is recorded as a debit to a cash account and a credit to a liability account is called, so this is where we get paid ahead of time. Let's see, before this, let me read it again. Received before services are performed, and we debit cash, so our cash goes up, and our liability account goes up, which would be the unearned revenue account. So we call this an unearned revenue. 18, which of the following is not a typical example of a prepaid expense? Supplies, insurance, rent, wages. It's pretty common for us to prepay for supplies, or we purchase them and they sit as an asset. Prepaying for insurance is common, preparing rent is pretty common, but prepaying wages is not common. So the answer is D. 19, the difference between an asset's cost and its accumulated depreciation is called its book value. We just established that right number 16. All right, 20, cash received before services are performed are recorded as, so if cash is received before we perform the services, then we're going to record that as a liability, right? The asset cash will go up and a liability will go up, called a unearned revenue, that we will owe the person who gave us the cash either the money back or the performance of the service. All right, adjustments for unearned revenues. So here, when we make the adjustment, if we took the money ahead of time and our cash went up and our liability went up, then when we've earned the revenue, we make the adjustment that will make our asset go down. I'm sorry, it won't make the asset go down. It will make the liability go down, and it will increase our revenues because we've earned the revenue. So we're going to decrease liability and increase the revenue. All right, adjustments for prepaid expenses. So again, think of the initial transaction. When we prepay an expense, our asset cash goes down and our expense goes up. So when we make the adjustment, let's see, oh wait, I'm sorry, I lied to you, sorry. When we prepay an expense, what happens is our asset cash goes down and our asset prepaid expense, whatever it is, prepaid rent or prepaid insurance, it goes up. So when we make the adjustment, then we've incurred the expense. So our expense will go up and our asset, prepaid insurance or whatever it is, will go down. So there'll be a decrease to the asset and an increase to expenses. Number 23. I'm not even going to try to say that company's name. Purchased office supplies costing $5,000 and debited supplies for the full amount. So their supplies amount increased. Supplies on hand at the end of the accounting period were $1,300. The appropriate adjusting journal entry to be made would be, so we're going to say if they purchased $5,000 worth, and then at the end of the period they have $1,300 worth, that they must have used up $3,700 worth of these supplies. So our adjusting entry is going to be to reduce the amount of supplies we have with a credit entry of $3,700 and to claim them as an expense with a debit of $3,700. So it'll be C, supplies expense $3,700 and supplies $3,700. 24, on September 1st, the Petite Sizes store paid $12,000 to the Mega Mall company for 3 months of rent beginning September 1st. Prepaid rent was debited for the payment. If Petite Size store prepares financial statements on September 30th, the appropriate adjusting journal entry to make on September 30th would be. All right, so if they paid $12,000 for 3 months, then if we're going to do 1 month's adjustment, which will be $4,000, right, because they paid that on September 1st, and we're making the adjustment on September 30th. So after 1 month, they've used up a month's worth of that prepaid rent. So the rent expense will be increasing, and their prepaid rent asset will be going down when we make the adjustment. So we'll have a debit to rent expense and a credit to the prepaid rent account. All right, 25. On July 1st, Mesa Verde Inc. purchased a 3-year insurance policy for $12,600. Prepaid insurance was debited for the entire amount. On December 31st, when the annual financial statements are prepared, the appropriate adjusting journal entry would be. All right, so here they made the purchase on July 1st. They paid $12,600 for a 3-year policy. $12,600. I'm going to divide that by 36 months. That's the number of months in 3 years. That's $350 per month. And then I'm going to say, okay, they did this on July 1st, and we're making the adjusting entry on December 31st, which means 6 months. So if $350 is for 1 month, we'll multiply that by 6, and it will tell us that it's a $2,100 adjusting entry. We're recognizing that they've used up $2,100 worth of their prepaid insurance, and they're claiming it as an insurance expense. So there'll be a debit to insurance expense and a credit to prepaid insurance of $2,100. Number 26. At December 31st, 2013, before any year-end adjustments, McCarty Company's prepaid insurance account had a balance of $2,700. It was determined that $1,500 of the prepaid insurance sorry, I had a little window pop open there, that $1,500 of the prepaid insurance had expired. That means was used up. The adjusted balance for insurance expense for the year would be, all right, so let's read it again now. They have a prepaid insurance account with a balance of $2,700. It was determined that $1,500 of the prepaid insurance had expired. The adjusted balance for insurance expense for the year would be, so they're trying to be tricky here, but really, if that's the amount that expired, then the journal entry we would enter would be prepaid insurance expense, debit $1,500, and prepaid insurance, credit $1,500. So the balance, assuming there was no balance before, of the insurance expense account will be $1,500. Okay, 27. On August 1st, the Darius or Darius, king of the Persians and the Medes, purchased a photocopy machine for $8,000. The estimate, what would the king of the Persians and the Medes need a photocopier for? Seriously, they had scribes. Anyway, so they purchased the machine for $8,000. Estimated annual depreciation on the machine was $1,680. The company prepares annual financial statements on December 31st. The appropriate adjusting entry to make on December 31st of the first year would be, so if this is the amount of depreciation for 1 year, then all we do for the adjusting entry is we do depreciation expense on the debit side and accumulated depreciation on the credit side for that amount, $1,680. 28, Bonita Realty Management Company received a check for $30,000 on October 1st, which represents 1 year advance payment of rent on an office it rents to a client. Unearned rent revenue was credited for the full $30,000. Financial statements are prepared on December 31st. The appropriate adjusting journal entry to make on December 31st of the year would be. All right, so if $30,000 represents 1 year, we'll divide that by 12 to figure out how much rent that is a month, $2,500. Now they received the check on October 1st. So this is going to take in the months of October, November, and December. So we'll multiply the monthly rate by 3. So there's a $7,500 adjustment occurring here. And then what would the adjustment be? Well, they're going to debit the unearned rent revenue account because they no longer have that liability because they've now delivered the service, which was rent of the space, or the office space. And they're going to credit the rent revenue account, meaning they earned the revenue. So that's B. 29. If the adjusting entry is not made for unearned revenues, the result would be to blank. All right, so if we didn't make the adjusting entry for an unearned revenue, then that would mean that we would not be showing revenue that we earned, and that we would still be showing a liability that we no longer have. So we're going to be overstating our liabilities and understating our revenues, right? We're going to be showing a liability that we don't have, so our liabilities will be higher than what they should be. That's overstated. And we won't be showing a revenue that we've earned, so our revenues will be less than what they should be or understated. All right, prior to an accrual adjustment, the revenue account and the related asset account, or the expense account and the related liability account, is understated. Ooh, that's confusing. Let's talk it through here. All right, so prior to an accrual adjustment, the revenue account and the related asset account. So if we're supposed to make an adjustment, then our revenue account will be understated and the asset account will be understated. Let me think of it again. And then the expense account and a related liability account will be understated. That's confusing. So talk through it. If we were to receive revenue, let's see, the only options with revenue is we could receive cash before the service is performed. So if we then perform the services, our revenue account would be understated, but our cash account would not be, the asset would not be understated. The other revenue opportunity could be revenues for services performed but not yet received in cash. So if we performed the account, if we performed it but we hadn't recorded it, then that would be understated. If we'd not yet received the cash, we didn't report the account receivable, then our asset account would also be understated. So that could be true. I don't know how they expect a student to talk themselves through this because I'm struggling with this one. Or an expense account and the related liability account. So we're talking accrual adjustments. That was part of how I got confused. I was thinking it could be either. On the expense, accrued expense, the expense account and the related liability account, before we record it, we're showing less expense than we really have, true, and less liability than we actually have. I think that's true as well. So I'm going to put true, but I'd say there's a fair chance I'm going to miss this one just because the wording is really confusing. So let's grade the test. It says I got a 97%. Let's see which one we missed. Better not just be that last one. Look at that. Nope, it wasn't that one. We got that one right. All right, it was here on number 27. So on August 1st, oh, see, I got so caught up on the king of the prince and the whatever he was, of the Persians and the Medes, that I messed this up somehow. So we purchased a machine for $8,000. The estimated annual depreciation on the machine is $1,680. If the company prepares financial statements December 31st, oh, you know why? Because I did a whole year's worth. I did $1,680 worth of depreciation expense when I answered B. And he'd only had the copy machine since August 1st. So that's August, September, October, November, December, 5 months. So what I should have done is I should have taken a year's worth of depreciation, $1,680, divided that by 12 to get a monthly depreciation, and then multiply that by 5. And I would have found out that he actually only depreciated $700 worth for those first 5 months during the first year. So then we would do depreciation expense of $700 and accumulated depreciation of $700. All right, that's the one I missed. Okay, that's the end of the walkthrough for the Chapter 4 self-test. Again, hope you found it valuable. And if you're using it to get ready for the test, good luck on the test.